Hello Sector Watchers, welcome to the show. This is the 205th episode of Sector Spotlight for Monday, the 29th of January. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. Today we're going to take a quick look at asset class rotation, we'll look at sector rotation, make a quick comparison between cap-weighted and equal-weight sectors, and we wrap it up with a look at seasonality for the upcoming month of February. Ladies and gentlemen, this is Sector Spotlight. Let's kick off the show as usual with a quick look at what's happening in asset class rotation. Got the weekly RRG left, daily RRG on the right, and as you can see it's still quite distorted by the Bitcoin tail, both on the weekly as well as on the daily. Going through a quite a big correction. We could take a look at the price chart in a minute, but for now I'm going to switch off these tails so our chart becomes a little bit better readable. So what's left now is the weekly RRG, quite still a lot of tails inside the red lagging quadrant. So they're for government bonds, high yield, the US dollar, and both commodity tails. It's a little bit different on the daily, where we have both the US dollar and commodities, GSG inside leading, as well as SPY stocks. And then we've got a very clear rotation into or further into lagging for high yield government bonds and corporate bonds. And we see DJP catching up, at least moving in the same direction as GSG. So for the time being, I'm not going to look at commodities at the moment. So I'm going to take away DJP and GSG, and I'm going to do the same here. Take away GSG and DJP, fit the charts. We got, again, a little bit better of a view. The US dollar is quite interesting because it's picking up slightly on the weekly RRG, and we can see how the daily tail moved into leading. It's losing a bit of relative momentum, but it's still moving to the right on the RS ratio scale, so that's a positive. Together with SPY, and SPY is the interesting asset class here. Stocks are the interesting asset class because you can see that on both the weekly and the daily, the direction of the tail remains the same. It's moving higher on the RS ratio scale. It's either picking up on the weekly relative momentum axis or very stable, slightly higher on that relative momentum axis. And that means that both RRG lines continue to move higher, which means that SPY stocks are in a relative uptrend versus VBINX, and that uptrend is being pushed higher by strong momentum. So it's all good for the stock market right now, especially when you look at the comparison between stocks and bonds. They're very much in favor of stocks, because here on the weekly you can see that all three fixed income asset classes, corporate bonds, government bonds and high yield, are all rotating in a negative angle. Governments and high yield are already inside lagging. Corporate bonds have just shaved off the 100 level on the RS ratio scale, but they're heading lower and back down to the lagging quadrant again. All in all, this still paints a pretty positive picture for US stocks, at least over fixed income, but also in general. So I'm going to take a look at stocks, the US dollar, and some of the fixed income stuff. If we look at the US dollar, here's the US dollar index, still moving away from that support zone, so that's good. And more interesting, if you look at the, let's start with the daily, here you can see how that break from that rising channel is materializing even better. You see how after that initial break, you had that, how beautifully that former support line acted as resistance, and we're now moving lower. And you can also see that on the weekly RRG chart, weekly price chart for the US dollar, for euro dollar, where it's dropping out of that trend channel. And the first target, I think you will pretty much at least see the low here, that's 107, but very likely we're going to test the lower boundary of that range, and that is in the 104.7, slightly below the 105 handle in euro dollar. So that's a good outlook for the euro dollar. So that means actually strength for the dollar, because euro dollar lower is strength for the US dollar and weakness for the euro. Let's take a quick look at SPY. So here is the stock market versus the benchmark, the Vanguard Balanced Index Fund. That breakout in terms of relative strength very clearly there, and look how nicely that break is to the upside to new all-time highs. So there is no doubt about the positive outlook for stocks over VBINX. And if we look at the price chart for SPY, just on a regular chart, you can see how this break to new all-time highs is holding up very well. It's moving away from that former rising resistance line, so it's getting that break is getting more and more confirmation that it's solid and it's valid. Even if you would think there was going to be a negative divergence in the RSI, that is now gone because the RSI has just taken out its previous high as well. So there's no negative divergence that's looming over this current rally, nor in the RSI, nor in the MACD. And finally, we look at the daily chart for SPY. You can see it a little bit more granular, and here also no negative divergence to be seen. Very strong chart, pushing to new highs, and we're only going to wait and see where this ends. But for the time being, market's definitely going higher, and stocks are beating bonds. So a quick look at government bonds. They moved back into that range. A little bit of a setback here, but it looks as if we're starting a new series of higher highs and higher lows. But more importantly, the relative strength of government bonds versus VBINX is moving lower, and it's continuing to move lower, and that means that there is a very clear preference for stocks over bonds. Moving on to the sector rotation in US stocks. If we start with the weekly RRG, then we can see how real estate, financials, and technology are still camping inside the leading quadrant, but they are losing a bit of relative momentum on the JDK RS momentum scale. On the other hand, we've got communication services inside weakening, but that's picking up in terms of relative momentum. So all these sectors are still in relative uptrends, with communication services probably in the best shape for the time being. Real estate, financials, and technology still okay, but giving back something. On the other side, we have a couple of sectors that are very clearly moving further into the lagging quadrant or into the lagging quadrant. Those are utilities, materials, and consumer discretionary. Consumer discretionary, this is better, makes it better visible. So we have materials and we have utilities, all three moving lower into the lagging quadrant. And then we also have consumer staples moving into the lagging quadrant. It's a very short tail, but it is moving lower, so that is in a negative setting. And on the other hand, we have healthcare, which is moving into the improving quadrant from lagging. That's an interesting move because healthcare is considered to be a defensive sector together with staples and utilities, where we see very negative rotations for staples and utilities. It's carrying on from the last few weeks. And that improvement continues in healthcare. Talked about it with a few people, and the arguments were that there are still a couple of very good growth names inside the healthcare sector that are currently dragging that sector higher, making it less of a defensive play for a lot of investors. And on the other hand, we've got energy very far into the lagging quadrant, picking up a little bit of momentum, but as you can see, it is very detached from the rest of the sectors and moving lower on the RS ratio scale, so it's better to be avoided. If we take that to the daily version, we see that both technology and communication services are inside the leading quadrant and moving higher on the RS ratio scale. So communication services now definitely the best because it's moving at a strong RRG heading on the daily chart and is turning back up on the weekly chart. So those tails are now going to get back in sync, which makes it a good outlook for communication services. If you look at financials, that is picking up inside the lagging quadrant while the weekly tail is still moving higher. So if that improvement in financials continues, we may see a sinking of those tails on both weekly and daily for the financial sector as well. And then we have technology, and technology here on the daily is moving, this is healthcare. healthcare is moving into the lagging quadrant, and that is conflicting with that weekly tail, as we've seen it here on the left-hand side. So mixed signals for healthcare. It's joining utilities and staples into the lagging quadrant, and we keep technology and communication services in the top right-hand corner. The other sectors still moving on, pretty much continuing what they were doing last week. We see a pickup in energy. That's the result of, or I should say that the weekly pickup is the result of the improvement of the daily tail for XLE. But nevertheless, this is all very low readings on the JDK-RS ratio scale. Apart from financials, which is the only one that's starting to pick up into the right direction, all these sectors are moving lower on the RS ratio scale and or at a negative heading. Makes the foundation, the broader foundation for this sector rotation, if you look at the cap-weighted stuff, very narrow. We're basically only looking at technology, communication services, and to a lesser degree, I think, financials. And that's about it. If you talk in cap-weighted terms about which sectors are leading the rally that we are currently seeing in the S&P 500. So let's take a quick look at a few of those important sectors that are leading, as we just said. Let's kick off with technology. So we have that under our belt. Here you see how the technology sector continues to rally. This is just a very strong chart. Relative strength pushing to new highs, and you can see how the weakness or that rollover in RS momentum is caused by that short sideways dip that we witnessed at the end of last year. Communication services, right here, you see is challenging an important resistance level, and it looks as if it's breaking it. So combining the tails on the RRG with this price chart, I would say that communication services is actually in pretty good shape. I think that in the next couple of weeks we can see higher prices in communication services as well as stronger relative strength. So please keep an eye on the communication services sector, because it's one of the sectors that is doing really, really well and sinking both the weekly and the daily tails on the RRG. What about real estate? If we look at real estate, we see that rollover here, and you can see how that is caused by the price not being able to take out that overhead resistance and dropping back below its previous high that did not manage to function as support. And if I bring that to a daily chart, we're going to probably see that. So here you can see how that started a new series of lower highs and lower lows, and how that relative strength is now really weakening. So the outlook for real estate in the next couple of weeks remains cautious, I think. Be careful with that one. It could go, because it's rolling over and the daily tail is really moving into the lagging quadrant. That could actually accelerate lower. And then the other sector that I want to take a look at is healthcare, because it is pushing into leading on the weekly RRG, but as you saw, its daily tail is moving in the opposite direction. So the final check is on the price chart for healthcare. And here you can see how healthcare is struggling to break to new highs. It managed to do it just a little bit. We're here already fighting that resistance area for a couple of weeks already, and still not being able to really penetrate higher. And that is causing relative strength to move lower and about to test support. If that continues, we will see a rollover, and you already saw the daily tail of XLV moving into that lagging quadrant, and you will see that when we move this one to a daily chart. Here you can see how that is rolling over and how relative strength is having trouble to keep up. Bit of an unclear picture here. Today was a good day. We'll have to wait and see if that carries over, but relative strength is suggesting that healthcare is going through a difficult, at least a difficult coming week, maybe 2 weeks. And then consumer discretionary, because that is a very important sector. It's a big sector, but obviously there's a lot of pressure there from Tesla on this cap-weighted version of the sector. And you can see how XLY is having trouble, didn't manage to hold up above its previous high here. It's now about to it's breaking support in relative strength, and that's causing the RRG lines to roll over, and that is causing the tail for consumer discretionary to move into the lagging quadrant. We're going to take a look at the equal weight versus cap weighted RRGs in a minute, and you will see how that looks actually quite different when you bring that consumer discretionary sector, which is a huge sector with a lot of industry groups and a lot of individual stocks, on an equal footing, and take out the impact of those mega cap stocks. So here is the equal weight version of the sector RRG. We're using the Invesco S&P 500 equal weight ETFs. Weekly on the left, daily on the right, and you can immediately see that this is way better distributed than the cap-weighted sectors. Obviously, because this is all equal weight, it's a zero-sum game. These are closed universes, which means that all sectors, all securities that are on the plot are in the benchmark, and it gives you a good overview of what's going on in terms of sector rotation. If we start on the weekly, you can see how that leading quadrant is way better populated than it was on the cap weighted. So we've got consumer discretionary actually moving into the leading quadrant. That is a very different tail, a very different rotation than that we saw on the cap weighted version. We got real estate pretty much on the same position. We got technology actually looking way better than on the cap weighted version, because it's moving just to the right, just continues to pick up relative strength without hardly any loss of relative momentum. That is a very different picture than that we saw in the cap weighted. And we have financials actually with the strongest RS ratio reading, but it's rolling over and losing a bit of momentum there. We've got healthcare solidly moving higher. It's the same direction as we saw on the cap weighted. And we've got utilities, materials, and this is RSPC here, that is communication services, moving into the lagging quadrant. That is also interesting. It's turning up, but it's not as good as the cap weighted. And we can, by combining these tails for cap weighted and equal weighted, we can sort of make up our mind and have input and guidance on whether we should be focusing on the larger cap stocks or the second tier, which means the probably mid and small cap stocks, because they are way more important when you look at the equal weights sector. So the mega cap influence is taken out of this. And if we then look back here, you can see energy is still on the far low end of this chart here, and consumer staples is rotating lower. That's actually also a very clear negative sign for staples as well as for utilities. If we take a quick look at the weekly version of this chart, you can see how technology is rolling over a little bit, but it's not as bad as on the daily. Communication services really confirming its strength. Financials doing way better. And here is industries actually also pushing into the leading quadrant. We got consumer discretionary here actually pushing higher, going into the improving quadrant at a good heading. So quite controversial. We saw consumer discretionary in a really weak spot on the cap-weighted sectors, and here we see consumer discretionary actually in a pretty strong spot on the equal weight sectors. And what I found the best way to compare those equal weights and cap-weighted sectors is by creating an RRG that looks at the ratio symbols for each sector. So I have got that prepared for you right here. And if you look at these symbols, these are always the cap weighted relative to their equal weighted counterpart. And the benchmark here is $1. And the reason we use $1 is because we're interested in the absolute move of that ratio symbol, because that is already a relative. This helps me to distinguish, to tell you to look at which sectors are better off in terms of the large cap stocks, so the cap weighted versions, and which sectors we should prefer from an equal weight perspective. And if we look here, then we can see that energy and utilities, we should probably prefer the cap-weighted versions, especially on energy and to a degree also for utilities. If you look at the others, then inside the weakening quadrant, we've got staples and communication services. They are curling back up. So this is an argument for communication services to stick with the larger stocks. They seem to be driving that sector much better than the equal weight version. The same for consumer staples. Consumer staples, we're better off looking at the cap weighted version, which means that we're better off looking at the large cap stocks, which have a big impact on that sector. For pretty much all the others, that's financials, industrials, materials, real estate, and definitely consumer discretionary and healthcare, those two primarily, we are way better off looking at the mid and small cap sections because the cap weighted stuff is definitely underperforming the equal weight stuff. So by bringing in those equal weight sectors can give you a much better handle on what's going on under the hood for US sector rotation. And let's wrap it up with a quick look at seasonality. It's the last show of this month. Next week we will be at a new month of February, so we're going to take a look at the seasonal numbers, the seasonal expectations for the coming month of February using the spreadsheet that the regulars are already familiar with. I've updated it until up until December of 2023, so this will be the sheet that we'll be using going forward in 2024. As usual, if you're interested in this updated sheet, drop me an email and I'll be happy to share it with you, no problem at all. And if we look at what's happening here, and remember the percentage for SPY is a price change, and all the others here are relative to SPY. So in case of XLB, 55% of the occasions over the last 20 years, XLB outperformed SPY in the month of February, and the average gain was 1.1%. Now, if you've seen this before, you know that I'm not very impressed with numbers around 50, 45, 50, 55, not even 60 and 40. If there is nothing else, then maybe, but only at 65, 70% or 35, 30% and up and lower. Those numbers are beginning to be significant enough to really pay attention. And if you look at what's happening over the universes here, and I have grouped them based on offensive, defensive, and sensitive, you can see that inside the offensive group, there is real estate, which is at 35%, which means that 65% of the time that sector is underperforming the S&P 500, and consumer discretionary is at 65% outperforming the S&P 500. Looking at the accompanying returns, then we can see that real estate average underperformance is 1.1% in the month of February. Now that is a pretty serious underperformance. So for the real estate sector in the month of February, the expectations are actually pretty weak. The odds are in favor of real estate underperforming SPY, and the expected underperformance is over 1% under the performance of SPY. Beware, this also means that it is possible that SPY goes up 2% and real estate only goes up 0.9 or 1%. So it doesn't necessarily mean that XLRE will drop in price. It's expected to underperform SPY. It's a pretty subtle but important difference. Now, if you look at consumer discretionary, the odds for the sector outperforming are pretty high, but the average gain is around 0, so that doesn't make a lot of sense. What it does tell me is, or gives me a little bit more confidence, is the performance for the equal weight sectors, because consumer discretionary isn't actually in bad shape based on seasonality for the month of February, and that is pretty much in line with those tails on the equal weight sectors. Not so much with the cap weighted, but definitely with the equal weight sectors. And then we've got utilities. That is weak expectation, but it's actually a very weak expected return, so that's completely in line with what we're seeing on the RRG tails. And here on healthcare, that is probably the lowest reading. So 70% of the time, healthcare underperforms the S&P in the month of February, and the average return, the average underperformance is 60 basis points. All in all, that is in line with the daily tail, not so much with the weekly, but with this pretty significant seasonal expectation for healthcare, I am quite confident to see that we saw that healthcare was struggling to move higher, that healthcare will be an underperformer in February. So will utilities with minus 1.3 and 45. The odds here are not all that, but it's made up by the weak expectation in terms of performance. And then real estate, which actually also has a very weak performance. So not much on the upside. The only one is really consumer discretionary, but the return is not much. So the bets, if you want to make any bets for me, would be to be underperforming or underweighted real estate, utilities, and healthcare. Those sectors are all set in terms of seasonality to underperform the S&P 500 in the month of February. And that wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. And please remember, Sector Spotlight is available on demand on the Stock Chart YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video. Looking forward to seeing you again at a new episode of Sector Spotlight next week, same time, same place.